Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include MBA forecasts and crystal balls, my interview with BeSmartee's Tim Nguyen on how improving the start-to-submit application journey is a major, often overlooked opportunity for lenders to drive significant revenue, reduce abandonment caused by poor tools or processes, and create a true competitive edge. And in the capital markets, what are remarks from Fed Chair Powell yesterday due to investor sentiment? Are you looking to deliver a complete digital mortgage experience? Look no further than BeSmartee. BeSmartee delivers world-class digital mortgage technology for banks, credit unions, and non-bank lenders. A true digital mortgage platform improves your consumer and lender experience, reduces costs, and reduces cycle times. Learn more at BeSmartee.com. Yesterday, I was devastated to learn that the 2025 Psychic Prediction Convention was canceled due to unforeseen circumstances. Yesterday, while the stock price of Better zoomed to the moon, the audience at the Lone Vision Innovation event in Atlanta heard from the MBA's Marina Walsh, who, speaking for the MBA's economics team and looking into the future, is seeing signs of a slowdown. Quote, "We haven't felt the full impact of tariffs yet. Job growth is slowing, and job search times have increased." End quote. The MBA believes that we'll see 2 to 3 Fed funds cuts coming up, but expect minimal impact on mortgage rates and 10-year Treasury yields. So don't expect 30-year rates to drop below 6%. But flash refi opportunities will continue to appear, with some companies better at acting quickly than others. Meanwhile, Fannie Mae believes that mortgage rates will end 2025 and 2026 at 6.4% and 5.9%, respectively, according to the September 2025 Economic and Housing Outlook. At least they're predicting something. Federal Reserve Chair Jerome Powell offered no hints on whether he might support a rate cut at the central bank's meeting next month, but did proffer in remarks yesterday that the policy rate is still moderately restrictive and equity valuations are fairly highly valued. Yes, the Fed will be taking steps toward a neutral policy rate in the coming quarters, but the size and timing of rate adjustments are data-dependent rather than preset. Without any major top-tier data releases this week to disrupt the broader macro narrative, upcoming sentiment and survey-based reports will play a key role in shaping expectations ahead of the September employment figures. Yesterday's 2-year Treasury auction saw lukewarm demand, with yields landing almost exactly where expected, though both dollar demand and indirect bids fell short of recent averages. Interestingly, the 2-year yield ended the day exactly where it was on September 5th, the morning August non-farm payrolls were released. Despite supportive economic data and a seemingly dovish Fed stance, the lack of movement highlights the market's muted response in the part of the curve most sensitive to future Fed policy. Sometimes the bond market says more by doing nothing at all. And the preliminary S&P Global U.S. Manufacturing and Services PMI readings indicated both sectors of the economy were operating in an expansion mode, albeit at a somewhat slower pace than the prior month, and at the slowest pace in 3 months. Both gauges remain above the demarcation line for expansion and contraction, although activity in both cases decelerated slightly from August. While the group's measure of prices paid for materials climbed to a 4-month high, the prices received gauge retreated to the lowest level since April, as cooler demand limited the ability of companies to raise prices and offset tariffs. Input prices in the service sector rose to their highest since May. For today's interview, I wanted to welcome back to the show BeSmartee's Tim Nguyen to talk about how improving the start-to-submit application journey is a major, often overlooked opportunity for lenders to drive significant revenue, reduce abandonment caused by poor tools or processes, and create a true competitive edge. He's chief executive and co-founder of BeSmartee. It was one of the original mortgage point-of-sale platforms, and he recognized that automating the mortgage process could improve and streamline the consumer experience, increase data integrity for lenders, and lead to a day where a consumer could enter fulfillment in minutes. I was at Acuma earlier this week. There's BeSmartee on stuff. There's Ask Bob. You guys are out there. I saw an article of yours in MBA Newslink, Application Abandonment, the Silent Killer of Mortgage Profits. I thought that was very well done. I always enjoy having you on the show because the discussions are so poignant and so pertinent for what is going on in the mortgage industry rather than any sort of sales pitch. And I can do the sales pitch for BeSmartee on its own. It seems like it sells itself. But love these conversations with you. I do want to talk
kind of what I read in that article and what's been plaguing lenders here recently. And that's getting from top of the funnel to the end. The start to submit seems like a huge hurdle out there right now in the industry. And maybe lenders aren't treating it like the metric that they should, or they're not properly quantifying for it. It's a huge deal. I'm hoping you can elaborate a little on that and kind of why lenders should put a lot of focus and effort into it.
Yeah. Yeah. Well, first off, thanks for having me on again. Appreciate that. Where do I start? I'll start this way. As a lending organization, right? Everyone tracks application to submission, submission to funding, unlock loans, beginning of the month pipeline, et cetera, right? As soon as it starts, the process. But there's one metric, and you mentioned it, right? Application abandonment that is rarely ever measured. I can count on one hand over the last 8 years of lenders actually knew that number. And if you're on a point of sale that's not BeSmartee, to be honest, you're probably hovering about 60 to 70% of conversion. That means when a borrower starts their application process, there's intent, and they finish that application process, and you actually have an application that then drives all the downstream metrics like application to submit, submit to fund, et cetera. What we found is 10% increase in your conversion yields 14% top line revenue increase. Think about that. You gave me $1, you get back $1.40. You give me $1 all day long, right? It's the tip of the spear, which makes it super critical. And I don't know why people don't measure it. We'll get into that a little bit later, but that is what we're talking about here. Is if you can increase it by 10%, you're gonna get 14% increase in revenue. And that's no additional loan officers, no additional lead buy, right? No additional processes. Now, what we don't factor in, but I'm going to be writing this article again soon for next month for MBA, is what is the hidden costs of trying to get unengaged people re-engaged into the application, top of the funnel pipeline. I don't know any data about that yet, but we're going to find out, and we'll share that out with the world.
We're talking huge changes to the bottom line, millions of dollars in revenue. And I don't want to speak in hyperbole there, but it seems like it can be agreed upon that it's still flying under the radar for so many lenders. That sort of upside they're leaving out there, that sort of meat on the bone that's still there. Why? I'm a little perplexed, but why?
So it's a question that I got asked recently, and we're still trying to figure out. But I have a couple theses I'll share, and as I find out more, I'll loop back and confirm or deny it. Let's split into two categories, right? Technology and process and people. From a technology side, it's not easily attainable. BeSmartee customers is very easily measured because it's our key metric. It's what we share all the time. I think the second thing is behavior, right? In a consumer direct world, I think they do measure it a lot better. We had a couple of those samplings in our data. But in a distributed retail environment, right? Traditional retail, it's usually the loan officer's responsibility to get an app. How they get that app, they talk to 100 people or 10 people or one realtor or 100 realtors, you don't really care. Like, you got an app, my timing for compliance and disclosures triggers. You submit it to the pipeline. I know what that ratio looks like. When you submit it, I know how far it goes, how long it takes, et cetera, et cetera. I think it's just a lack of desire. So unattainable data, difficult to get data, and a mentality that, well, that's a loan officer's job. I don't care how they do it. Just get me apps. So if you're averaging 8 apps a month, cool. But gosh, what if that could have been 11 apps per month? And now everybody wins in that value chain.
I had a discussion about this recently on the podcast where for a lot of lenders, it's, hey, I have this new AI tool that will call so many people, call away, call away. They're not quantifying what's lost in terms of starting an application and then losing that borrower. There can be huge unforeseen costs of not closing a loan file or starting the process and then upsetting a borrower and they go somewhere else. And I would love for the industry to get closer to a point where they actually value what is the fallout and what is that costing us, at least in your opinion, when we see this application abandonment, and I like that the alliteration of that phrase there, is it about the tools lenders are using, or is it the way that the people and processes are set up?
The tool definitely matters. That's the one thing people interact with, right? They're on their phone, they're on their device. They have to go through this technology that someone created. And so if the technology is long, it's not clear, it asks too many questions, it requires you to click the mouse too many times or scroll up and down too long, right? Those are all usability factors that affect it. Ultimately, when we look at technology, it's a really simple thing to do. You ask as little questions as possible. You have them use their mouse and their keyboard as little as possible. You make the process as short as possible, and you communicate extremely clear. If you do that, you're going to have the highest chance of a high converting funnel. That's a technology problem. That's up to the technology people to design, measure, and fix and do better. But it's really rooted in just really simple design philosophies, right? Do you want to fill out an application that's got 10 questions or 35 questions? Everyone's going to choose the first one. Nobody wants to spend more time than they need to. Now, from a behavior perspective, what we see too, this is where things get a little bit muddy. I think it's the expectations that originators set with their borrowers. Oh, just go ahead and get it started. I'll take care of the rest. It's an invitation to, provide first name, last name, email, and whatever information they're willing, and then they drop off, and the borrower drops off, and the loan officer will pick it up. On the flip side, I also see lenders who are overemphasizing data completeness of the 1003. So we've had a few clients in the past where they wanted every single data point captured by the borrower, which we achieved, and we did because it's very configurable to do so. You can ask as many questions as you want, but then they saw their conversion tank. They saw their operations people very happy because the data was more complete, right? They had a status, and it's a file complete or something like that. So that was really good, but conversion dropped. So that's an over design, right? And the other one's underutilization versus over design. There has to be a happy medium. That's what we saw for. So I think it's part technology, I think it's part behavior. It's also part just business philosophy.
Yeah. Well, let's get into the philosophy a little bit, because from my view, being able to step back and look at originators out there, a lot of people have a tool that will, chat with borrowers or can interface with them or compose emails. A lot of companies out there will have various productivity tools. They'll have the latest and greatest when it comes to the CRM, the point of sale, all these things. So what is the competitive differentiator out there? You could argue the relationship is as important as it's ever been. Or kind of this, what we're talking about today, this early application experience being a true competitive differentiator. Would you agree that that's something that lenders can really differentiate themselves from the competition with in today's day and age?
I do. And I promise it's not biased because I sell one. But it's one of your most prominent touch points up early. The most important is your relationships with real estate agents, right? The first conversation you have with a borrower, the rapport you build. That's where a lot of effort and salesmanship needs to go in, a lot of training, a lot of monitoring, a lot of tools like CRMs, listening to these conversations, like Accelerates, right? I love Josh's product over there. They're listening to it, they're coaching the loan officer. But that's completely ignored in the POS as of date. That's going to that's going to change what we're doing. And I'm sure what other competitors are going to be doing as well. So yeah, absolutely. It's important to to provide your best foot forward, right? You don't want to follow from a great conversation loan officer to a really mediocre, experience with a point of sale. It's too complicated. That value prop that you shine out to your borrowers, it needs to travel through the entire life cycle of a loan. Can't just be great here and then it fails step 2, and then great step 3, and then sucks to step 4, right? You need to sing those core, that what I call a North Star, all the way through the entire borrower journey. So yeah, I think it absolutely matters. Now, it's not the only thing that matters. It all matters, and the people that put them all together, they take an unfair chunk of the pie.
Yeah, and I would say that we've seen this happen in other industries. Maybe mortgage has been late to the game, but the phrase that's thrown out a lot of the time is this Amazon experience. Or I've argued for several years that the Tesla car buying experience is a really seamless one. It's easy, gets people into the cars. Is there an industry in general outside of mortgage that you feel like gets the application or the onboarding experience really right? And I guess, going one step further, what can lenders learn from that? And I've actually thought that it's really nice that we've seen some industries disrupted from the side, or even, the HELOC process in the mortgage industry kind of disrupting from the side, where now big time lenders can take some of that workflow into their own processes, adapt it, and make themselves more efficient.
Yeah.
Take some cues there. But an outside industry, you think the mortgage industry can model themselves on?
Yeah. It's interesting. Let's just talk about what an Amazon-like experience is. It means different things to different people. That was BeSmartee's original objective, and we actually built it. It was one place where you can go search for a bunch of different lenders, see rate, see price, get automatically approved right across the spectrum. So you know what? I really like this lender. Let me go ahead and just finish the application process with them all on one platform. So it's possible. The technology is there. We delivered it very early on. But what happened was it wasn't what the lenders it wasn't what the lenders wanted. The lenders, right, especially on the traditional retail side, they wanted to control the pricing conversation. They want to control certain points, right, for their loan officer to work their magic and their skill. And I get it. And so what they did was they took our system that was designed to go from basic application to a paid appraisal in about 15 minutes. And says, you know what? I just want an application. Maybe we'll run credit. Maybe we'll run verifications. Let's just start there. So we started there. Then the boom came, right? And that's all that mattered. And then the crash came after that. And now, like, who's going to extend it out in a market where the cost to advertise, market close, right, is really, really high, where you're losing money on every loan. So I totally get that. Now, I guess this is my long-winded answer. Robbie was saying, lenders don't want a Amazon-like experience. They say they do. If you're a consumer direct lender, you probably do up to a certain point. But we work in a very traditional manner where relationships trump, everything. So when we look at across other industries, I think home equity has done a really good job of getting people approved instantly and setting expectations and getting their money and funds fast. We see this in other lending industries like business, payday advance. If you have a pet, you go to the vet, you can't afford the bill. There's, I think it's Care Credit or I forget the name of the company. Their applications process is phenomenal, right? So I'm just focused on lending right now. Mortgage, yes, everyone's going to say, oh, it's just really complicated. You don't get it. Well, I've been in it. It's the only job, only career I know. Been out of college. I can't believe it's about 25 years now. And it's there, but people don't desire, they're not willing to market around it. There's a lot of emphasis placed on the loan officer, which isn't wrong. That's where the relationship's built. That's where the money is made. But there's got to be a continual march towards changing experience overall. It's not going to change in 2 years. Let's just be real. It's going to take 5 to 10 years for this to change. Now, what's behind all this too is if you look at the younger Gen Z, they're not going to want to sit there and talk to somebody. They're going to want to chat with a chat bot, right? They're going to want to talk to someone when they need to. But up until that point, like, let me do everything on my own. I'm going to do it when I want to do it and the way I want to do it. And just don't call me, text me, right?
Yes. Talk about where we are in this market cycle right now and why now is the time to engage with a company like BeSmartee, why you feel like it's really beneficial for lenders in this moment.
Look, here's what I would say. Very simple. Rates are going down. Volume's going up. We got a 2026, 2027 is forecast to be 2 up years, right? About 12% respectively each. I've been in the industry a lot. Our listeners have been in the industry a lot. If these aren't signs of a starting industry market that's starting to stabilize and grow, albeit a little bit slower than we like, I don't know what is. This is the best it's been over the last 3 years. Forget the pandemic boom. That stuff ain't happening no more. And if it did, we have much bigger problems. The most important thing, actually, I'll call this, I don't know if you heard me talk about a camel business before. A mortgage is a camel business. It's dry, desert, it's painful, it's probably feels like hell for the camel. I don't know. But they see a pool of water and they suck up all the water. That's the way I see the mortgage business. We go through booms, we go through dry periods, and we have a slight recovery. And right now we're on that slight recovery angle, right? And things will get better. So my say thing is this. You don't know how long this opportunity is going to last. It could be another war. Something bad could happen in the government. Like, so many things could happen, right? That can shift things. So when this opportunity that's on the horizon comes, take it. And the number one thing I would do is call BeSmartee, maximize your conversion, go from that 60, 65% up to 85%. You're going to get an increase applications. That's the tip of the spear for your application to submit, submit to fund, lock loans, whatever. But you got to get that tip of the spear right. And that will cut through and I'll just open up more deal flow into your pipeline for every loan officer, because you know what? I don't know how long this is going to be good. Eat it all up.
Yeah, eat it all up while you can. Although I will, and I don't think it's arguing with you, but the industry historically has been so short-sighted when it comes to cycles. Scaling up, scaling down, times are good. I don't need to plan for bad times. I would like to think that the severity of this last market cycle made it where companies really need to have some foresight. But like you said, at the same time, when the getting's good, get it, times are getting better right now. And there's a lift in borrower sentiment out there. And so it's like, all right, let's hit the go button. Let's hit the gas.
We're not learning the lessons of the past years as an industry. Now, if you're Guild or Rocket or UWN, you kept on investing over the last 3 years. You bought companies, you bought market share, you invest in technology. And because as a result, they're going to get an unfair share of the market. Everyone else, right? Things are great, we hustle. Things are bad, we pull back. And you're just rising up and down with the tides of the ocean. And it's great when things are good, man, but it sucks when things are bad. Like, I hope this time around, I just, for the love of God, like, for everyone's sake, during this period, make as much money as you can, spend that extremely wise, prepare for the downtime. So the towns will be there. This opportunity is coming up. It's not going to be long lived. It's not going to be forever. Just got to take advantage of it, man. That's what I'll just leave it with that.
I do really enjoy these discussions. And for regular listeners of this podcast, they will know that I don't say this often. It truly is refreshing hearing from you the times that we've had you on. And I look forward to having you back on again soon. So thank you, sir.
Thank you.
Today's economic calendar kicked off with mortgage applications increasing 0.6% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending September 19th. Later today brings new home sales for August. Expectations are for 625,000 versus 652,000 previously. A flurry of Treasury activity that will be headlined by auctions of $28 billion of reopened 2-year FRNs and $70 billion of 5-year notes before a buyback in 1 to 10-year tips for up to $750 million, and remarks from San Francisco Fed President Daly. We begin Wednesday with agency MBS prices unchanged from Monday's close, the 2-year yielding 3.57 and the 10-year yielding 4.11 after closing yesterday at 4.12%. Let's wrap up with a joke and some housekeeping. 3 dinosaurs stumble across a magic lamp. They rub it and a genie appears. I have 3 wishes, so I'll give one to each of you, the genie announces. The first dinosaur thinks hard and says, all right, I'll have a big juicy piece of meat. Instantly, the biggest, juiciest piece of meat he'd ever seen appears in front of him. Not to be outdone, the second dinosaur thinks even harder. I know, I'll have a shower of meat. Immediately, huge pieces of meat rain down around him. The third dinosaur, certainly not to be outdone, thinks harder than the previous dinosaurs. I've got it, he cries. I want a meteor shower. But, Thanks again to BeSmartee for sponsoring this week's podcast. It's the most innovative mortgage technology platform for banks, credit unions, and non-bank lenders. To learn more, visit BeSmartee.com.